Welcome to the deep dive. This week, well, we're looking at some sources that aren't just hinting at changes in crypto. They're basically shouting that the old rules, they're done, finished. So our mission today is to dig into the evidence, all from just one really pivotal week in late September 2025. A week where, honestly, the whole structure seems to have shifted under our feet. And here's the big takeaway right up front. Top analysts, we're talking a Bitwise CIO, the CEO of CryptoQuant. They've gone public saying Bitcoin's traditional 4-year cycle, it's over, dead.
It's a huge statement, definitely. But the context is, well, it's everything here. When we say the cycle's dead, we mean that old predictable rhythm, the one tied strictly to the halving, driven by retail getting excited, then panicking. That was the old game. What the sources are arguing now is that the drivers are fundamentally different. It's about sustained, large-scale institutional buying. And crucially, real regulatory clarity is starting to emerge. These things, they don't operate on a neat 4-year schedule. They bring in long-term demand, structural demand, that just kind of swamps those older patterns. We're shifting from, say, a scarcity shock cycle to maybe an integration shock market.
Okay, integration shock. I like that. Let's unpack the evidence for this because maybe the most visible sign that the institutions are really in the driver's seat now comes from derivatives. We've got sources confirming a pretty massive shift. BlackRock's iShares Bitcoin Trust platform. It actually overtook Coinbase's Deribit. It's now the world's biggest place for Bitcoin options trading.
Whoa.
Yeah. I mean, hang on a second. That's not just shuffling volume numbers around. That feels like a real power shift symbolically. Deribit was, for years, the place for crypto natives, right? High leverage, big whales.
Exactly.
Now you have a platform run by the biggest asset manager on the planet leading the charge in options.
It's precisely that. This isn't just, one bank testing the waters. This signals Wall Street taking the lead in the sophisticated stuff, the hedging, the risk management for Bitcoin. Options are how serious players manage exposure. So when BlackRock's platform is number one, it tells you the big established institutions are now setting the tone, managing risk, and ultimately driving price discovery.
So control is moving.
It's moved.
Yeah.
From the sort of crypto-native world to the traditional finance sphere. Formalized, you could say.
Okay. And if that wasn't enough of a signal, there's this prediction that really seems to fit this new institutional mood. Coinbase CEO Brian Armstrong, he's making an incredibly bold call. Bitcoin hitting $1 million by 2030, which, sounds like absolute peak hype, unless you connect it back to that institutional runway you just described.
Right. And that prediction, it leans entirely on that idea of sustained structural demand we've been talking about. He points to three main things only big institutions really bring to the table. First, just the sheer ongoing demand pouring through the spot ETFs. That's huge and consistent. Second, clearer regulations worldwide, which makes big money pensions, corporate treasuries way more comfortable.
Okay.
And then the really big one he mentioned, the potential for the U.S. government itself to build a strategic Bitcoin reserve.
Wow. A U.S. strategic reserve.
Can you imagine
if
the U.S. government started seriously holding Bitcoin? The effect on supply and demand would just dwarf anything we saw in the old retail cycles. It's a whole new ballgame. These drivers are systemic.
That really sets the stage. Okay, so if the cycle's broken and Wall Street's moving in, let's look at how the money itself is moving, both the really old money and the new volatility, which brings us to this great story. The awakened whale. There was this Bitcoin account, completely dormant, hadn't touched its holdings in 12 years, and then suddenly it moves everything.
12?
Yeah, 12 years of just holding. It's kind of amazing patience.
It really is. It's like a masterclass in long-term conviction, isn't it?
Yeah.
The analysis we looked at suggests that this wallet got its Bitcoin super early, sitting on something like an 830x gain.
Unbelievable.
And what's interesting is, while the institutions are the new big force, they're essentially trying to replicate that same kind of long-term patience these original hodlers showed. It's a good reminder that even with all the professionalization, you've still got these powerful early players who can make waves if they decide, okay, 12 years is enough.
So we have that incredible long-term view on one side, and then bam, the short-term drama, that crash we saw last week. Clearly, institutional involvement doesn't mean smooth sailing just yet. Bitcoin took a pretty sharp dive, fueled by leverage.
Yeah, it was a rough week for anyone playing with borrowed money. That drop wiped out, what was the estimate? About $1.7 billion in short-term positions, a huge flush out.
Okay, but the analysts jumped right on that, calling it a healthy reset. I gotta ask, though, how is wiping out $1.7 billion of people's money healthy? What's that really telling us?
That's fair. It's a critical point. It's healthy not because the price drop itself is good, but because of what got washed away. It was the excessive leverage. Too many people making speculative bets with money they didn't really have.
Ah, okay.
That kind of setup makes the market really fragile, prone to those cascading liquidations. So when that $1.7 billion in leverage gets cleared out, the system is actually less risky. You have a cleaner foundation for price to move based on, well, actual supply and demand.
Right, less shaky bets.
Exactly. The analysis suggests clearing out that froth creates a stronger base and maybe, just maybe, clears the path for a run towards that $130,000 to $135,000 range people are talking about. The pain was sort of needed to shake out the short-term gamblers, the kind institutional players aren't keen on.
Okay, that helps frame the volatility. Now, let's shift gears a bit from Bitcoin's price swings and look at how big players are treating other digital assets. This gives us a peek into utility beyond just storing value. We're seeing a pretty big shift in corporate treasuries, specifically spotlighting Ethereum. Sources show BitMine, an institutional holder, now has an Ethereum treasury hitting, get this, 2.65 million ETH. That makes them the top corporate holder of Ether.
That's a massive statement. It shows that for some really sophisticated players, Ethereum isn't just like a platform for developers anymore. It's being treated as a core treasury asset, sometimes alongside Bitcoin, maybe sometimes even instead of it.
Why Ethereum, though?
Well, likely because of its utility, right? You can potentially generate yield with ETH. You can use it to secure decentralized operations, participate directly in DeFi. It offers this sort of active potential that goes beyond just holding Bitcoin. It's an active treasury management strategy, not just a passive store of value.
And you see that confidence reflected in VC money too, right? Andre Cronje, big name in DeFi, his new venture, Flying Tulip, just raised $200 million.
At a $1 billion token valuation, no less?
Wow.
Yeah, it's a huge valuation for something still relatively early.
Yeah.
It just underscores that the venture capital world is still incredibly bullish, specifically on DeFi infrastructure. They're not just funding apps, they're funding the core plumbing, the rails that this whole decentralized financial system is going to run on.
Okay, let's talk about that plumbing then. The actual infrastructure being built out for these institutions. Binance, the huge exchange, they're making a big play here, positioning themselves with this crypto as a service offering. COS, they call it.
Right, COS.
And it sounds like it's basically a ready-made package for traditional banks and finance firms, offering trading, custody, and importantly, compliance tools all bundled together.
Compliance is the magic word there. Think about it. If you're a traditional bank wanting to offer crypto, the biggest headache is the infrastructure. How do you handle KYC/ML, all the different regional rules, transaction monitoring, keeping customer funds separate and secure?
Yeah, it sounds like a nightmare.
Exactly. So Binance's KML is basically saying, look, don't worry about building all that complex regulated stuff. We've already done it. Just plug your customer interface into our backbone. It dramatically lowers the barrier to entry for banks and brokers. And of course, it positions Binance not just as a place to trade, but as potentially the fundamental infrastructure provider for traditional finance moving into crypto.
That's the finance infrastructure. But we know Web3 aims to go beyond just money. We're seeing enterprise uses pop up in data and operations too. Chainlink has this new AI-powered tool that's apparently getting traction for things like streamlining corporate actions and sharing data globally. For someone listening there, what does streamlining corporate actions actually mean in practice?
Okay, yeah, good question. Think about how messy things like stock splits or dividend payments are in traditional global finance, or big mergers. You've got data that needs to be perfectly synced across maybe dozens of different systems, different countries. A lot of it is still surprisingly manual, slow, easy to mess up. So Chainlink's tool aims to use blockchain, combined with AI, to automate and secure that information flow. Imagine a company declares a dividend. This tool could ensure that the official data point gets shared instantly, verifiably, and immutably across every bank, broker, and regulator connected to the system. It turns a process that might take days and involve lots of manual checks into something potentially minutes long. It shows Web3 tech becoming potentially essential for just basic core business processes, even outside of crypto itself.
That really is deep integration. Okay, finally, let's touch on the regulatory future, which, as we said at the start, is maybe the other big force killing that old 4-year cycle idea. We saw a key figure step down, Adrienne Harris, who headed up New York's main crypto regulator, the NYDFS.
Yeah, that was significant news.
And in her exit interviews, she floated something potentially game-changing for global institutions. She called for a U.S. UK crypto passporting scheme.
Passporting. This is one of the most important regulatory ideas floating around right now, I think. If you're a huge global bank navigating the compliance maze in the U.S., then separately in the U.K., then the EU, it's incredibly complex and expensive.
Sure.
A crypto passport would mean if you get regulatory approval, say, from Harris's old agency in New York, that approval would automatically be recognized as valid in London, and maybe vice versa.
Ah, okay. Mutual recognition.
Exactly. It's a massive step towards standardizing rules, at least between key allied financial centers. And that kind of framework directly enables the smooth cross-border digital asset business that global institutions need. It shows regulators are shifting from just reacting to crypto to actively trying to figure out how to make responsible institutional adoption easier and faster.
So putting it all together, this really felt like a week where that whole theme, the professionalization, the institutional takeover of crypto went from being kind of a theory to just hard reality on the ground. You see it in the BlackRock options volume. You see it in corporations like BitMine building huge ETH treasuries. You see it in giants like Binance offering institutional-grade services like
The
KiddoSess.
pieces are all fitting together, aren't they? The evidence points pretty clearly towards the end of that purely retail-driven, emotion-fueled boom and bust era.
Okay.
We're entering something, well, more mature, more compliant, more focused on building the actual infrastructure. The market's being rebuilt professionally.
And we talked about that crucial idea, the U.S. UK crypto passporting scheme, as a potential key to unlocking truly global institutional finance in this space. Which leaves a really interesting, maybe provocative thought for you, the listener, as you watch this unfold. We know simpler compliance is basically essential for getting the really big players involved across borders. But what does that mean for the original promise of crypto, its sort of borderless, open nature? If these national or maybe allied regulatory frameworks, these passports, become the main gateway for institutions, does that inevitably make global finance a bit less open? Or is this kind of structured, regulated path simply the only practical way forward for crypto to achieve true mass adoption and legitimacy with the world's biggest financial players? Something to chew on as this new institutional structure keeps getting built out.